Good evening, everyone, and welcome to our Niger Startups webinar session titled Unpacking Central Bank Policies. We'll be exploring the impact of CBN regulations on the economy in 2024 and beyond. I'm your host, Boma Anthony, and I'm the Community Engagement Lead and a Project Administrator at Niger Startups. Okay. Niger Startups is a business network with 95,000 member startups and business leaders in Africa and the diaspora. Our community serves as a platform for investor readiness, capacity building, and access to top opportunities. We also share opportunities for business networking and forging partnerships to fuel your entrepreneurial or professional journeys. I'd now like to introduce our moderator for tonight's session, Aramide Abe, who is the founder of Niger Startups. She's also a business leader and a global speaker who is committed to driving macroeconomic development through entrepreneurship and job creation. Her leadership has fostered collaborations with major organizations, providing accessible development to thousands of African entrepreneurs. Over to you, Aramide.
Thanks so much, Momo, and thank you, everyone. It's a pleasure to. I haven't spoken on our webinars in a while, so I'm a bit rusty. But thanks everyone, and thanks to all for being here. Most of all, thanks to our moderators, our panelists. I beg your pardon for taking time to, share with us and discuss on today's session. I'd like to introduce our first speaker, Mr. Samson. I have to pronounce his last name right. Esemuede. Pardon me if I've damaged, I've battered it. He's MD CIO at Rosk Investment Management. Has a wealth and depth of experience spanning Europe, as you can see, the Middle East and Africa. And of course, he is a CFA charter holder. We're privileged to be hearing from him today. Our next speaker panelist is none other than our own member, Dele Akintola, a seasoned executive with more than 15 years in equity capital markets. He's worked in banking almost all of his life. He's now working in FMCG, an innovative technology distribution startup. And so he'll be, of course, giving us his perspectives, not only from sort of like a banker or former banker's viewpoint, but also being in business and in the actual economy, and seeing how all these changes, all these announcements and policy reforms are impacting us. It's a pleasure to have both of them on. We do also have some very seasoned I'll say experts in the audience today, and we'll be very keen to, of course, have their contributions and questions when it's time for Q&A. But I think the way we're going to run this, and sorry, welcome again, Samson, and welcome, Dele. I'm not sure I can see them. I think it's just the profiles being displayed. So I will carry on. I don't know if their videos are on, but yeah, it's a pleasure to have both of you here. We had kind of agreed that the way we will run this is more of like a discussion, format, as opposed to just shooting questions to them. We're going to just take a look at a few of the sort of most popular announcements and reforms that have come in the last maybe month or so from the Nigerian Central Bank. Of course, the focus is the Nigerian banking sector. So without further ado, I'm just going to go straight into it in the interest of time. I think maybe the most popular one is the review of the minimum capital requirements of banks. I remember when that was released, I had to sort of message maybe Dele and a few other people to say, okay, so what does this actually mean? Because I'm not a core banker. And so I'll be very keen to maybe sort of have you break that down. And maybe I'll start with Samson just to share with us, okay, so what does that mean? Does that mean that these banks will be shut down in 2 years if they don't go and raise more money? And why are they raising more money? So maybe we'll start with that.
Thank you, Aramide. Glad to be here. Welcome, everyone. I'm probably the wrong person to ask that question. I would have rather Dele gone first. But just because I have a lot of views that might be considered non-conventional with regards to the timing, right, and the way the recapitalization was announced. So we can go into that in a bit more detail. And I also have a bit of reservations around the concept of absolute capital requirement for bank, given that we kind of have a Basel framework that defines how banks should be regulated. But for the purpose of your question, banks in Nigeria historically had a 25, depending on the category, but I think for the international banks, they had a 25 billion naira minimum capitalization requirements. I think this was instituted during the Soludo reform. And this is equity capital that banks needed to hold in order for them to qualify for the licenses that they had. The thinking around the reform is that this minimum capital requirement was implemented when the naira value was around, I think, 117 or so to the dollar. And so when you look at the dollar value of that 25 billion in today's term, it does appear that the banking sector is not as capitalized as they should be, hence the reason why the minimum capital requirement was increased multiple folds. So for the international banks, which is most of the banks that most people here would be familiar with, the minimum capital requirement is 500 billion. For the national bank, it's 200 billion, and for the regional banks, it's 50 billion. So that is the requirement, and then I would lead the floor to Dele to put some context around that, and then I think we can peel the onion a little bit because it's a complicated topic. Yeah.
Thanks, Sam.
Okay. Over to you, Dele.
Thank you, Aramide, for having me. And hello to everyone on the call. So the question that Aramide asked was, how? Obviously, the central bank has given the banks 2 years to complete that process. So if you go back to when Soludo did his capitalization plan, right? What happened? You either had banks who met the requirements, you had banks who decided to go the route of M&A, right? So those are sort of the two directions that we saw. So that I don't think what would happen now would probably be very similar. But I think the third option you have here is that banks now have the ability to downgrade their license, right? So if you are an international bank and you can't meet the 500 billion requirement, and you happen to be at 350, you can decide to downgrade your license to a national, right? But what that then means is that you have to shut down every international operation that you have across the world, right? In order to meet that capital requirement. And if you are currently a national bank, or you're currently a national bank and you can't meet that requirement, you can decide to downgrade your license to a regional bank and then meet the capital requirement of about 50 billion, right? So those would be the three possible options. And how do banks, hope to raise this money? They either go out to do a rights issue or do a fresh capital raise from new investors. So we do expect that over the next, and I think just going by data available, I think the sector is going to be raising something north of 3 trillion naira across all the banks in Nigeria. And I think the question we've asked ourselves, and that's to Sam, was that, in principle, banks are able to use their retained earnings and classify it as capital, right? What the central bank is saying here is that retained earnings would not count. Now, so you're looking at the valuation of any bank, right? Especially when you're building your DCF model and you're valuing a bank, and you look at the book value, you would include the retained earnings, right? So for someone like Sam, who's clearly investing in all these banks, he would value those banks, the book value based on the retained earnings in the book. If the central bank is saying that you cannot capitalize your retained earnings, he's essentially telling me that the retained earnings are zero. For some of these banks, the retained earnings is as high as 1 trillion naira, right? So if I have to yank out 1 trillion naira from the valuation of any bank, obviously the valuation of that bank will crash significantly. And I guess we've also had the argument around, I guess the real issue here is, I'm not a regulator, so I don't particularly understand what they're saying. But if you look at, for instance, the results coming in from GT Bank and Zenith in the last few weeks, you can see that a lot of the banks have taken the opportunity to increase their provisioning. So provisioning in one of the banks was as high as 400 billion. So they're essentially trying to use those retained earnings, that allowance, to clean up their books. If the central bank will not be allowing them to take those retained earnings and use it as capital, when they're trying to raise money.
Thank you both for sort of like just painting the picture better. I want to sort of just prod a little further. Is this some sort of exceptional case, or have we seen this in any other country where the central bank then says you can't use your retained earnings? Or is this unique to Nigeria? Is this something we've seen before? Why is everyone alarmed? I guess that's my question.
Aramide, that's a brilliant question, and I myself and my team has been digging to kind of get a sense of where this has been applied before. I think let's dimension it in two sides, right? I know I'm not the central bank. I don't know what they're thinking, right? But I find the concept of recapitalization within the ambit of tight monetary policy to be contradictory, right? So I have reservations around the timing, given the other policy stance of the central bank. So that's the first one. The second is really this idea of absolute capital requirement. I have always found quite strange because a lot of jurisdictions are getting rid of it. It's quite peculiar in an instance to Nigeria. But even within that context, reducing, not just retaining, there are also some sort of reserves as well that is I think it's as good as capital. It's capital. And excluding retained earnings from capital, for me, as an investor, makes me start to have reservations around the quality of the bank books that I invest in, because ultimately the regulator has a lot more information than I do. And if the regulator is basically telling me that they don't assign a weight to the capital of these banks, then why should I, as an investor, do the same? There are certain aspects of retained earning that is quite complicated because some of them are not realized cash, some of them are, so it's a complicated answer. But in my opinion, right, I almost feel that this is almost like a shortcut solution to solve another problem, right? Because there are reservations and there are issues around certain qualities of bank books and how they calculate the risk-weighted assets, which is how banks determine how much capital they need to hold relative to the assets that they have, right? It does feel like what I have seen in other jurisdictions when there are concerns around the quality of a banking asset is that you do what they call a stress test. You do what they call an examination. And that examination under a very standardized format, and you can stress the model anyhow you want as a regulator, and then you can then publish capital shortfalls, and then you can give banks time for them to be able to plug those capital holes. I think that's the hard work that I feel like should have been done. So basically it's almost like it's a nuclear option to solve what I see is a legitimate concern. And that's what is very disturbing for me.
I think two things I'd like to add to what Sam has said is that, first of all, obviously there's a portion of retained earnings which is cash, right? So I think it will be interesting that I think sort of middle ground I would hope we can get to is where the central bank would allow the banks to use the cash portion of the retained earnings and be able to capitalize those as capital, right? I think that would be a nice middle ground to get to. I do realize that I do also, I mean, again, if I was the regulator, it would almost suggest, I mean, so you have, KPMG and all these big audit companies, certifying these bank statements, right? So if the central bank is saying that retained earnings is technically zero, which is what you're telling the investors, I put a big question mark on all the audited accounts and even the accounts that the central bank has approved over the last God knows how many years. The central bank we can also say that central bank has also provided forbearances for a lot of these banks, right? So it'll be very easy for the banks to actually for most, right? So the bank can essentially say, for all these banks that have been provided forbearances for, can you net off the forbearances from your retained earnings and let's know what's left, right? Again, that's very speaking to what Samson has said, but that hasn't been done yet. So I'm guessing maybe this is just maybe this is a first stance. It'll be nice to see that the central bank, potentially provides better color. But it's one that worries me because obviously we know the central bank governor did not speak a lot in the first few months of his tenure. People wondered why not, right? And I do find that he's the kind of guy who's obviously taking some time to think through the problems we're trying to solve, how we solve it, and what's the way forward. So I imagine that this capitalization thing is something that they've probably done extensive work on. So it's for them to have come with this position, it then gives you a big question mark around the entire banking sector. To be fair, there was one other point.
So I think that the challenge, right, Dele, is we should get information. So I think the lack of information from a perspective of an investor is what is a bit problematic, right? So if we can get a sense into the thinking, right, of what the CBN is looking at, right, then we can make an assessment. As things currently stand, I think when there's lack of information and when there is uncertainty, we think worst case scenarios, and that may not be true, right? The worst case scenario in this bank is that you discount, and these are very interesting kind of draconian move, right? Because for example, if you look at a bank like GTCO with about 1.4 trillion of capital, right, of which most of it is retained earnings, because the actual paid up capital and share premium in that business is about 138 billion, and that retained earnings have been accumulated through the life of that business. The regulator is basically telling you that what that accumulated earnings is, it's not worth much, right? Based on what they said, and that's what is problematic. But if they come and say there's a portion of that retained earnings that we gave forbearance for, there's a portion of that retained earnings that are unrealized gains, and we have concerns around asset quality, come up with a framework, get your examiners in and do the work. So I do feel there are legitimate concerns. I just think the approach has been quite draconian. It's a topic we can flog for the whole of this conversation. So hopefully we can segue into something else, and then we could come back if you want us to.
Yeah. No, but these are great perspectives. Sorry, go on.
Something for Sam. So obviously the question then goes to, if you're going to raise this amount of capital, the question is, what are you going to do with the capital? If we go back to the day of Soludo, the banks became big overnight, and guess what happened? We had AMCON, right? Yeah. The big fear is we've had an economy where the economy is not growing, the banks are not lending. Banks have to then have capital of 500 billion. The question then is, what are the banks going to do with all that cash? Are they going to be buying treasury bills or just chasing government securities, or do they go on the shopping spree of bad loans, and then we have to create another AMCON too? So that's, I guess we can read.
Another AMCON. No. So I love your perspective, because this is the reality, right? This is what investors are looking at. And so you've sort of mentioned maybe 2 or 3 things I want to pick on. And the final one is signaling, which is what Samson is obviously representing. And it's interesting because I've been in DC at the IMF meeting. So when you talk of signaling, we'll come to that. But I wanted to get an understanding of what forbearance is. There's nothing like a stupid question. So let me just clarify what that is for the purposes of us who don't know, Dele. So please define that. What is a forbearance?
So forbearance will be situations where central bank looks at a loan within the bank that potentially is questionable. So, obviously you have the prudential guidelines where if a loan is, bad for so day, you provide X, you provide Y, depending on how bad those loans are. Obviously, if you look at the sector, you had situations where oil prices went from 100 to and crashed down. So you had situations where loans, particularly in the oil and gas sector, struggled. You've had loans in the power sector, given all that has happened with subsidy or subsidizing electricity, where we're not having cost reflective tariff, where loans in that sector have also struggled. But the central bank can say these are sectors that we find that are important for banks to support. So you can then give some sort of forbearance in terms of restructuring those loans to ensure that you don't have to call in those assets prematurely.
Okay, fair enough. And then just to clarify, so there's the international banks from what I hear you say, but what is a regional bank versus a national bank? Like what does that mean? Is that
The
a micro?
regional bank would be, which one exists?
Providus.
Yeah, exactly.
Okay.
So they would operate within, say, Lagos and Southwest, as an example. Maybe
Oh,
Lagos, Southwest,
okay.
and Abuja, right? So again, regional,
see.
right? It all depends on the regions where they also want to operate.
Okay, so I wasn't aware of that. So that's good to know. So maybe we'll okay, and then on the signaling aspect, having listened to the central bank governor at the IMF meetings in DC a week ago, it did seem, at least from the sort of like energy and temperature and also the press releases that came out of that, that the reforms and the measures that had been taken were positive, or at least looking from the outside in. So when Samson sort of represents I guess a European or Nigerian investor and talks about how there's so much uncertainty, isn't that contradictory, given that the way he's now come across to communicate the reason why it took some time, they had some unprecedented measures, was this was the reason, and now this is where we are, this is what we're doing, and we can actually see, or at least last week where the Naira was sort of strengthening. Isn't it a bit contradictory to then say that then there's still a lot of uncertainty with institutional investors, local investors? So maybe that's my question
So
to
let's
Samson.
so it's nuanced. It's a bit sad
Right.
that we started from the bad conversation. We should have started from this, right? I think on the monetary policy side, right, they've done a pretty decent job.
Right.
Although, right, you could argue that the problem that they solved was probably created by the delay in actually dealing with that problem. So you attempted to liberalize the exchange rate in July without adequate preparation, and without putting in place a team, right? And as a result, there was a complete loss of confidence. And oftentimes in markets, when you don't do things when you're supposed to do them, at the time when you then get to do them, you have to do a lot more than you actually would have needed to do, right? So better late than never. They were late. I have a very strong view that we didn't really need to see Naira at 1,000, right? If we have implemented the policy sets that are now being implemented today in July and in August, we probably would have been around the 800 levels, and that would have been seen as aggressive, right? Now we are now in a situation where people have seen the Naira at 1,900, right? You now have to deal with breaking that psychological barrier. So Nigeria is in an interesting place, right? Because institutions have been battered, credibility have been lost, right? And as a result, we're currently in the rebuilding stage of getting credibility back, right? And Olayemi Kaduso, the CBN governor, in my opinion, have done well in solving a part of the problem. And we'll go back, right? Because I hear a lot of comments around this exchange rate problem. And it's multifaceted, right? It's a hydra-headed dragon. There are two aspects to it, if I want to simplify it. There are structural issues around the exchange rate, which is a function of productivity and long-term supply-side economic factors, right? And then there are market-related failures that has exacerbated the situation. Oftentimes, we commingle the two, right? Because I hear people say, oh, Naira is going to go to 3,000 because Nigeria doesn't produce anything. And I often tell people, yeah, but Nigeria has never really produced anything, but it was stable for such a long time. So this is not new information that the market is suddenly now aware of, right? The reason why the exchange rate weakened as much as it did was the total loss of confidence, which was a function of the market failing, right? And we can go into details of how the market failed. And what Olayemi Kaduso has done, right, is to address a lot of those frictions that didn't allow the market to function properly. So he's in the process of doing that, but obviously trust is a very important thing in financial markets. Credibility is a very important thing in financial market. People want to believe, people don't want to believe what they are seeing. So anytime there is any sort of concerns around how these people are posturing, people panic, right? So that's why it is very important not to err in the communication side. So
Right.
So when I'm negative around the recapitalization, it affects me as an equity investor. Doesn't necessarily affect the fixed income guy. But the fixed income guy looks at it and say, if they're thinking about this way in equity, what else can they think about on the fixed income side that could possibly hurt me? Especially when I'm sitting on 50% gains from the currency and the 2 months of carry that I've gotten, right? And that is why, like, communication consistency at this point in time when things are very fragile and policy sequencing is very, very important. I feel like we are trying to solve too many things at the same time and we haven't sequenced policy properly, which is why we are dealing with this uncertainty.
Okay. Thank you for that. On that note of policy sequencing, so wouldn't you say the different announcements, the reforms, and I'm going to go into a few of them. I mean, I listed them and shared them with you last night. Is sequencing, or maybe it's just my own sort of layman understanding, revoking of the BDC licenses, unprecedented increase of the benchmark interest rates, and then further increase. So I'll stop there. And then, of course, the big elephant in the room, which we addressed, which is the recapitalization. Isn't that some sort of sequencing, or do you feel like that's just ad hoc? It's reactive.
So no, it wasn't reactive. It was well thought out, but it was well thought out to solve one problem, which is the market failure with regards to the exchange rate, right? I think the recapitalization might be linked to the exchange rate in a way, because I think there is some weird belief from people that it's going to be a way to bring dollars into the country. I have strong reservations around that. But so that might be the link. But that 17 or 18 circulars that the CBN produced within the space of 2-3 weeks, right, were good, well thought out, well sequenced, and it's something that most market participants that understood Nigeria have advocated for months, right? That's brilliant. They did a fine job there, right? But that is one part of the problem. There's a fiscal side to the problem, which no one is talking about, which is we are heavily reliant for our exchange rate stability on what you call hot money, right? Which are short-term carry trades, people who are coming into the market, which is why, because of the gains that they've made, things are quite volatile. To get that stability, you need to also do things on the fiscal side. There hasn't really been, in my opinion, very, very concrete moves to solve alternative sources of dollar supply, because you need that to create a cycle of confidence, which is what I say sequencing. And then this recapitalization creates a bit of doubt, right? Because people are now like, this administration takes a very market favorable posturing in their conversations, right? But when you then come up with an action that is deemed to not be market favorable, people start to question your intentions. And I think that's where we are.
Fiscal policy. You know, when I was looking online yesterday doing my research, I found very little on fiscal policy. So it's interesting that you say. So I want to put this question to Dele. In terms of fiscal policy reforms, what were the lowest hanging fruits that you feel were not taken advantage of as at where we are now?
Can I quickly just maybe speak to some of just build?
Okay.
I think first of all is that central bank governor came in sometime October, November, right? So I wouldn't honestly put the blame of whatever happened between May 29th to that date on him, right? I think people got into government and just thought, you know what? I'm sure there's that video of the video where Tinubu said the exchange rate is gone, right? Or the way we announced subsidy is gone, right? But they didn't have a full understanding of the problem that existed on ground. I guess no one even thought that things would have been that bad. I think the second thing that obviously happened was, there was the release of the central bank financial statements, right?
Okay.
So whatever assumptions we made around how bad things were, those statements just, affirmative confirmation, right? So it was very simple for me to sit down wherever I sat and say, you know what, I'm happy to speculate against, I'm happy to put a short trade here or speculate against the currency, I know that the central bank had zero machinery to fight back, right? That was probably what led to the currency going from whatever level we went to 1,900, right? Just because people just knew that central bank had no ammunition. I think the third thing is, what does success look like? And I think it's a question that I always ask myself in my business every day. What does success look like? And I think, whilst, we've had 8 years of, I guess, very abusive relationship with the central bank, I think what success looks like to me today is just really a 180 turn of everything we've done in the last 8 years. As if you unwind everything that we've done in the last 8 years, that is probably the low base for success today. And that's probably what, the central bank governor is doing today. Because the analogy I use is, you look at a house and say, there's a house that has no water flowing in it, right? The plumbing is bad, right? There's a lot of water outside. So the question you're asking yourself is, how do I get water to flow into the house? There's a pump. But when you pump the water into the house, they're just leaking pipes all over the place, right? So the first step you need to do is, go in there and just fix the pipes, right? You fix the pipes, you fix the pump, and then you get water in. That is what, now, whether the water chooses to come in, so water in this case would be the investors, right? What you need to just do is get the mechanism for which, so all the crazy policies we had in the central bank over the last 8 years, we're unwinding all of that and just creating just a healthy environment for people to do trades and things to work. On the fiscal side, I honestly find, I don't want to sound too brash, but what's the point of having a finance ministry that hasn't raised a dollar? It's been 7-8 months and not $1 has come into the country. Apart from the deal that was done between NMPC and Afrexim, right, which was also very expensive for funding. If you ask me, I'm a big support. I'm a big pro just going to the IMF, to be honest. I not looking at sequence. If you look at what Egypt did, right, Egypt decided to, first of all, they found the money. Then they came and said, you know what, we'll liberalize the currency and we'll take interest rates up, right? So the money was there. So they did two things. They removed subsidy, they did all of that, but then they had money to say, we will attack the problem. In our case, what we did was, we didn't have money. Then we said, we're liberalizing, we're removing subsidy. They're just, again, just that sequencing of, and that's because there is no synchronization between the fiscal side and the monetary side. I think for the most part, I would give a very complimentary pass mark to the monetary side. I think on fiscal side, there's just a lot lacking. Yesterday there was this big conversation around this announcement about the 2.25 billion that was coming from the World Bank at 1%. And then someone asked the question is that, have you seen any communication from the World Bank on the issue? Right. And the answer was no, right? And the analogy is that, okay, why bother speak if we don't have a letter, a commitment or something? But we're engaging, it hasn't happened. Why go and, almost like the Dubai issue or Dubai visa issue, where we go and say, oh, the visa,
the 10 billion line of sight.
Borders will be opened by so date. Meanwhile, you don't have a commitment from the other party. So I find some of these things are quite worried. But so I'm really hoping that the fiscal side will, and then obviously even at the IMF spring meetings, you saw some contradictory statements being made on the fiscal side.
Yeah.
Just some statements that just particularly were not too encouraging on my, in my perspective, where they suggested that, we don't have a choice but to have a high interest rate environment, right? Inflation is at 32%, food inflation is almost at 36%, so we don't have the luxury of having a low interest rate environment. And you just saw some body languages there that were just not aligned with what the realities on the ground should be.
Yeah, to that point as well, when there were questions about coordinating and alignment with, I guess, finance or the ministry, there wasn't much said. So yeah, there is, I guess, still a lot of work to be done in terms of coordination, but even on the fiscal side. And interestingly, when I was looking up the 2.2 billion loan on Reuters, it said intends, so Nigeria intends. It didn't say it's been done. You know what I mean? It's only like Vanguard and, all Nigerian publications that kept saying, okay, it's in the bag. So I guess we need to also be careful about sort of like just running before we walk. So, but yeah, thanks for those questions. So maybe I'll just come to, I know
So
there's
can I just touch on the fiscal
okay.
side quickly so that it doesn't just
Go
feel
ahead.
like we're just bashing, right? I mean I think I think on the revenue side, right, because the exchange rate has been weak, and I haven't really done the analysis to pieces part because there's clearly been improved revenue, right? FAC allocations have gone up, right? There's a part of that I think is largely linked to the exchange rate and not really as a function of things that they've done. The removal of the subsidy was supposed to be quite positive, but the subsidy is sort of back through the back door because when you look at the exchange rate and you look at the price of plats, I struggle to think that you cannot. I suspect you're probably landing PMS at 850, 900, right? So there is an implicit subsidy that is probably larger than the subsidy when the subsidy was removed, right? So that's something that needs to be solved. And this is a very sensitive issue, right? Because in order to properly solve the subsidy problem, you need to solve the exchange rate problem because it's interlinked, right? And I would have expected a little bit more there. So revenue mobilization has increased. There are talks of improving tax revenue ratios. So I feel like the finance ministry is quite busy doing the things that it wants to do. But unfortunately, we're in a crisis mood, right? So in a crisis scenario, you prioritize, right? And one of the priorities is that you need to bring in dollar liquidity. I think the market was open for us to do a Eurobond. I think we've appointed, from what I understand, we've finally appointed bankers, or we've announced that we are going to do it. But I think March was probably a great time to have done that because at that point, everybody was expecting global interest rates to come down, but we didn't. We missed the window of opportunity. So it's like, and that would have helped, right? Because my biggest concern right now is this stability that we're seeing can be ephemeral because, right, because of the quality of the capital that comes in. It's normal in a liberalization process that the capital that comes in initially is quite hot by nature, right? But what tends to happen is that as soon as you get credibility, because at the moment you get like the emerging markets trading desk in London and New York, and you get the sharp hedge funds that are doing frontiers kind of stuff, they're coming into the market. But those people are very return focused and they're very unforgiving when things go wrong, right? And when you then get more credibility and people start to see the dollar inflow, you then get the stable real money capital that comes in, the real money funds, the Fidelities, the BlackRocks, the capitals of this world. And then after that, right, you then get the FDIs, which are long-lasting kind of capital, right? The problem is that we are one way into this, and it is now we're beginning to lose a bit of confidence, and we shouldn't be here, right? And it's this lack of sequencing is sort of why I feel that we are here. I'm still quite optimistic that we will be successful, right? But unfortunately, if you let things slip, what you then need to do to then get credibility back will be more than what you currently need to do. And that's what makes me a bit uneasy.
Thank you for the balance, the balance perspective. And I think, it's all about perspective. It's from where one is sitting. So really appreciate your genuine contributions. And so before we go into maybe other monetary policy, March MPC outcomes, I just want to speak to or ask about the 400 basis points increase. Was that too drastic? Do you think, that was what was needed? And maybe I'll start with Dele and then Samson. 400 and 200.
So the initial, I was actually going for 500 at the initial. So I think it's very simple, right? You have to look at what's return, what's the real rate of return, right? Essentially, what you have here is inflation is at at that time it was at 29%, right? Any instrument you put money into in Nigeria, I think was sub 20, right? So essentially, if you put money in Nigeria, that's negative real rate of return, right? Yeah. So what you need to do is to try and get interest rates to catch up with inflation, right? And that was where you saw that now T-bills are now being issued at somewhere around 21%. If you with effective yield closer to somewhere around 27, right? And then there was a second hike, which was 200 basis points. Frankly, for me, I still, just giving again, given where, I still feel like there's still room to hike a little bit, but I'm not sure that there is again, what's the word? I think the economy is,
the appetite.
I don't think the willpower is there. But again, well, on the flip side, what the central bank has done is they've been very tight with liquidity. So what you saw is they hiked the CRR. What is CRR? CRR is essentially we got hacked to 45%. So what that means is if I have $100 as a bank, which is deposits, right? $45 of that sits with the central bank at zero, right? The next thing you obviously know there is the liquidity ratio, which is essentially at 30%. What that means is that 30% of all of total deposits must be in near cash or cash equivalent investments. So treasury bills, blah, blah, blah. So if I had $100 of deposits, 45 is the central bank at zero, 30% is in near cash investments. What you're left with is 25%, which you can use to lend. So central bank is saying to the banks, go and look for money elsewhere, to go and borrow from, but essentially the capital from deposit, the lending from deposits that has been closed significantly. So yeah, but I still think that there's probably still scope to take some more. Yeah.
Okay.
So this interest rate topic is interesting. I mean, in my opinion, interest rate is not even high enough, right? And it sounds draconian, but at the end of the day, if the central bank is posturing that its mandate is inflation targeting, and inflation is at 33%, which is higher than their own forecast when they presented in February, right? In my opinion, you should be tightening more, right? And the central bank tells you that it expects inflation to taper down by the end of the year to 21.4%. Under this current monetary system, that is not going to happen. So you need to tighten, right? The second part of the question that I have is, who does high inflation affect, right? That's the most, who does high interest rates affect, not inflation, right? In my opinion, right, is so when you look at credit in the economy, the total stock of credit in the economy is about 40 trillion. This economy has a nominal GDP of about 260 trillion. It's not a credit, that is less than 20% credit penetration. And that credit is highly concentrated in a few hands, right? So high interest rate for the most of Nigerians doesn't affect anybody. The real people that high interest rate affect is the government themselves, right? And we could all agree that the government should actually be in a fiscal consolidation mode and they should not be expanding, right? So if we get interest rates sufficiently high enough, right, to put pressure on the fiscal side to go into a fiscal consolidation mode, that is a positive, right? And then the channel where high interest rate, where people really get hurt is on the exchange rate, right? If you ask a business person in Nigeria today, what would you prefer? A stable, predictable exchange rate or high interest rates? They will tell you a stable, predictable, or low interest rates. They will tell you a predictable exchange rate 9 times out of 10. Right? So if interest rates allow you to achieve exchange rate stability for the bulk of Nigeria, that is a positive, right? The people who are complaining that interest rates are too high are the people that got us in this mess in the first place.
So why is that? Is that because we're heavily dependent on the dollar, which is why people sway towards the most stable exchange rate, or what, versus low interest rates?
So, I mean, low interest rate is good, right? But like you need to sequence it, right?
Yes.
What has happened, but what has happened, right, in the last 8 years, right, is the central bank has created money out of thin air. So money supply, right, pre-2013 has gone from like 8 trillion to 90 trillion overnight. In an economy that is growing by less than 2% every year, that is, I mean, for example, last year, money supply growth was about 50%. Right? And the economy didn't grow. So when you're creating that much capital, right, and that capital cannot enter into productive use and it's tied up in small hands, what does it do? It gives the money to the government or it buys dollars, right? So that's what you're trying to shrink. Once you're able to achieve a reduction in money supply or a significant decline in the growth in money supply, right, and inflation starts to recede, right? Because I hear arguments from people that, oh, the inflation problem that we have is driven by structural issues. There is a part of inflation that is driven by structural issues, but the spike in inflation from 12% to 33% that we have now is basically exchange rate pass-through that is a consequence of money supply growth, right? So these are the things that needs to be addressed. And then when you are able to achieve that stability, right, you can then cut rates. right? You can then bring borrowing costs down. The challenge that you have is that you cannot have low cost of borrowing, right, in an economy that is like in an economy where the exchange rate is in free fall. It's like trying to eat a cake and have it. And that's where we are. And we need to understand, right, from a macroeconomic standpoint, where we have to make decisions from perspective of what is least bad, not a perspective of what is good. Ideally, we all want stable exchange rates, we all want low interest rates, we all want economic productive growth, right? You can't have all of them at the same time. So you pick and choose your poison. At the moment, what is killing us is inflation and exchange rate volatility. So we need to do what we need to do to kill that problem, and then we'll deal with productivity growth later.
Yeah, amazing. Very clear. Okay, thanks for that. Final point before we open up to, I think Rolake is on, so we'll have her make one contribution and then we'll move into questions. And can I just ask that when we ask questions, we don't want commentary, we want questions so that we can make use of the time. If you have a comment, please share it in the chat. Final point or maybe question is maybe other MPC outcomes that were maybe overshadowed by the main elephant in the room, which we discussed. Would you like to touch on any of those or speak to any of them? Dele and then Samson.
Okay, I touched on some of that already. So we've hiked the interest rates by 600 basis points in total. CRR is at 45%. I think that should even be maybe closer to 50. But some bank CFOs will have my neck if I said that. Liquidity ratio is where it is, and you obviously saw that they adjusted the loan to deposit ratio policy down to, was it 65? No, from 65 they brought it down to 50 or so. Okay. So yeah, and then I think the last thing was really on the SDR, the standard lending rate and the standard deposit rate. Right. But I think that what's important is, for us is as an economy, we either have to choose inflation or growth. Yes. I would choose inflation any day and every day because it is extremely sticky, and obviously we can see what that's doing to us as an economy today. For business owners on the call who are wondering how does that affect you, is that you should expect that your bank should write you a letter to say that your interest rates on existing facilities will be going up. In many cases, some banks will tell you to pay down because they're tight on capital, right? And the central bank is essentially signaling them not to lend. I had situations where people have told me that banks have called to say, "Can you please close the loan position?" Right? With the customer. So I still think that central bank, all of that will feed through into the economy with time, but we still just need a little bit of stuff to happen on the fiscal side, which isn't happening, I guess, at the speed that we want. But yeah, that's.
Is that some? Thanks for that. And sorry, is that something that happens where the bank communicates about interest rate hikes, or is that's not very common in these parts, right? I know I see it in the UK.
They need to send you a letter to inform you of your of an increase in your interest rates, and that would happen.
Okay,
they do. So okay. I think the reality, right, that we are sadly confronted with is that the economy has to sort of shrink, right? Oftentimes you go through this period after you've built up a lot of excesses. So it can be quite painful, but at least you have excesses that allow you to actually deal with the adjustment better. This is a very unique situation for me, that you've gone through what in my mind is almost like depression environment over the last 8 years, because you have population growth around 2.5% and you have GDP growth hovering around 2%. So there's been a complete destruction in purchasing power over the last 8 years. I feel like if you do the regression, we're probably back 30 years. We probably lost around 50% of our output in real terms. That's the scale of the destruction that has happened. So when people are having to deal with this pain, right, and then you then have to implement this sort of adjustments that is going to serve to shrink this even further, there are social issues around this problem. And when I think about Nigeria, my biggest risk is not even economics. My biggest risk is social, right? Because I'm like, I can't understand. I can't fathom how people are surviving, because people didn't benefit from the excesses, and now you're telling them to take the pain. So if I was in DSS and I was doing my job and I was thinking about Nigerian stability and the risk around that, I think it's social, because the question is, would things, how bad would things need to get before they get better, and how do you manage the socio-economic fallout of that? That is the rope that they need to tread, right? It's not, you cannot liberalize electricity, liberalize gas prices, liberalize exchange rate, yes, it's good. As an economist, yes, I like it because it sets us down the path. But the problem is, once you stiffen the resistance of people towards reform, the ability to conduct reform becomes impossible. And that is a big risk.
I think to add on that is, on this issue of subsidy, is that if you look at, Ethiopia is today going to IMF, right? And obviously the IMF has listed the things that need to be done. Angola by themselves are removing subsidy on fuel, on electricity. All the countries around Nigeria are poorer than we are, right? And they all pay $1,000 naira per liter, right? So I still think that, by all means, we need to absolutely remove subsidy on fuel. That's one. I think number two, we need to go to IMF. It's very unpopular. People think, but I'm saying that if we've taken all this pain, right, I might as well get paid for it. I get $3, right? I think that's something we should be doing, but there's just this historical bias that IMF is the devil,
Yeah, it's almost like, at what cost? You know what I mean? Like, and there's always a cost.
We've already
but we already paid. We've paid the cost, right? I do not understand the visceral opposition to an IMF deal within our political and economic elite construct. It's an irrational fear, in my view, right? Because I think it's the scars from the structural adjustment program which led to obliteration of wealth, right? But the problem is that we're already doing structural adjustments anyway. If you get a $20-30 billion IMF tax stabilization package, we are not even talking about an exchange rate crisis anymore, right? so it's like, I know that it's very unpopular, but unfortunately we have to make a popular decision, because expecting hot money, hedge fund boys in London and New York to give you $30 billion of liquidity is a fast stretch, right? They are likely to give you that money if there's an IMF deal, not if there isn't, right? So and that's what I'm worried about, right? That's what I'm like. We've anchored our FX stabilization strategy, right, at least in the short term, to the ability for us to attract hot money. That can be useful, but are we prepared to do what we need to do to ensure that there's follow through? That's where the risk is.
Great context. Okay, thank you so much for those contributions. I'll come back on sort of final thoughts later, but I'll open the floor up to one of our members, Rolake. Are you on?
Hello, I'm on.
Contribution. Yeah.
Hello,
please go
I'm
ahead.
on. Yeah. Hi, everyone. Please excuse my voice. So I had so many things I wanted to respond to going back to the beginning, but I think I wanted to just offer a small perspective, especially on the investor sentiment. In terms of my, sorry?
Yes, please go ahead. Sorry.
Just to give you some idea of what the investor universe is currently saying. So in terms of my background, I straddle both a role as a financial journalist on Arise News, anchoring Business Week, and also a full-time job at Zenith Bank as head of corporate development and investor relations. Of course, I can't comment on the way this impacts banks specifically because I'm constrained, but I have my views which I can share in private. But I wanted to talk about some of the feedback we're getting in our interactions with investors, particularly around the capital raise. Well, the first one is just to buttress what was said by the speakers, that there is concern in the investor community, no doubt, around the timing of the recapitalization plan. There is concern that when you look at some of the ratios, the key performance indicators of some of the banks, it's kind of baffling why the CBN would do this now. So some investors are of the opinion that this shouldn't be happening at all. Some are the opinion that the timing is off. And clearly, in my role, I will have to go on roadshows globally and internationally to speak with investors, whether that's institutional investors, asset managers, sovereign wealth funds, whoever. But there's signaling that perhaps appetite is not as strong. And it's not necessarily a Nigerian specific thing. If you look at equity capital markets, particularly frontier markets, in Africa, that appetite has waned in recent years. Investors have obviously struggled to get money out. The devaluation has been a challenge. So there's that question of the timing. The second part of it, which I can give feelers on, is really around in the event that banks do ultimately go and raise capital. And I say in the event because, as you know, in economics, anything can change. I don't think the CBN will do a complete U-turn, but I do see a very, very remote possibility that there could be a revision to the scope and nature of the recapitalization push, right? And that could be many forms. And some people would say maybe you're being idealistic, but you have to play out all scenarios if you're working in the banking sector. The first one could be, okay, why would we look at a percentage of retained earnings and we actually peel back on what that is? From a bank's perspective, obviously, to hear some of the comments that have been made on the panel around retained earnings and whether there are concerns from investors that there's a bigger systemic risk on the horizon. We've even heard some extreme views, not here, about whether this equity is fictitious. But part of the problem with communicating to investors and riding on a market that depends heavily on confidence and sentiment is that if your communication is not total and complete, and if you don't help investors read in between the lines, they will read in between the lines and make assumptions. So that is a possibility that should not be entirely dismissed. The third thing I would also say is that there are alternative ways to approach this problem, and there are many ways to skin a cat. And of course, banks cannot lobby for obvious reasons because we're a vested party. But there are alternative ways you could look at achieving and strengthening the capital bases of banks without excluding retained earnings. And I think those are some of the things that need to be explored. Obviously, our stance is always comply first, ask questions later. But I just thought I would sort of, just give the view that investors are perplexed. In the event that some banks do right issues or public offers, investors are very clear about what their ask is, particularly existing investors who've stayed loyal for many years, who haven't taken dividends out of the country and reinvested it. They are very clear about what would be acceptable and what would not be. And from a banking perspective, part of what we'll be doing on a roadshow is trying to incorporate their feedback, their input, their insights into how we eventually structure any capital raise. I wish I could be more specific, but the constraints of my role sort of prevent me from doing that. Thank you very much.
Thank you.
Thank you for the input, Rebecca.
Yeah, thank you. A balanced view is always good, and of course, the perspective from the big financial sector is great as well. I don't know if there are any reactions from Samson or Dele on that before we move into questions.
No, I largely agree with what Rolake said, right? Especially because the interest rate environment allows these banks to be highly capital generative from an internal capital generation standpoint. And frankly, right, when you're talking, I think I've heard this 1 trillion economy thing bandied around, but I just think this is not the time to be having that conversation when you're trying to shrink the economy. We could have been able to achieve this, right, if you allow the banks to generate internal capital, and then once you're able to slay this dragon called inflation and achieve exchange rate stability, there's going to be a reduction in cost of risk across the entire market, and then valuations are a lot higher, and there's a clear road that banks can then start lending, right? You have a situation like one of the banks that I'm invested in has 2.4 trillion it has a 9.6 trillion balance sheet, but 2.4 trillion of loans, right? Clearly, that bank is not doing any lending. So you then tell that bank to go and raise like 500 billion to do what exactly, right? But and it's like, oh, lend to large ticket items. They're not coming, right, in this market environment, because frankly, if my zero risk weighted asset is giving me 27% effective yield, right? In order to get the same return on my lending, I have to be doing a significant premium on that. Frankly, from a credit risk perspective, if I have to do that, I'm expecting you to default. The implied probability of default on a 40% financing is more than 50% over a 1 year period, right? So that's the thinking that I feel like it's the conversation is not nuanced. But again, I'm speaking from a position of not having complete information, right? I don't know what the central bank has. I don't know what they've seen, but they are basically telling me that there's fire on the mountain, so I'm trying to run, right? That's pretty much.
Yeah, sorry, Aramide, there was just one. Yeah, I'm glad you brought that issue up again.
Well,
Sorry.
okay, we don't have a lot of time, so can you keep it short,
Okay.
please? Thank you.
Sorry, yes, that was the other issue I wanted to sort of just raise. This fire on the mountain, allusion to fire on the mountain. I think it's important to bear in mind that banks are one of probably the most highly regulated sector in the Nigerian economy, if we want to be honest. You know, we publish financial results that are audited by the Big Four. And I think when we're looking at when we say things like what the CBN knows that we don't, it's important to be very careful that we're not kind of fueling investor sentiment around what could be going on in the Nigerian economy, what could not be going. What we do know is that we have an ultra conservative CBN whose prudential guidelines are even more stringent, for instance, than what you have in many other parts of the world. So I just thought I would put that perspective there. Thank you.
Thank you for that as well. Communication, which they could do better on for sure, is one thing. I mean, we're seeing memos almost every day now, so I imagine that they're realizing that that's key. The CBN governor mentioned trust, building trust and confidence in the economy is his ultimate goal. So let's hope that that happens. But yeah, anything from you, Dele, on what was shared just now before we move into questions?
Just to add on, just a point on when Sam was talking about the reaction of hot money and how they are unforgiving, right? They do what is necessary. I'm sure we've watched a lot of these movies, you know, where Big Shot and all of that. So the question is, what's happened with the FX going from 990 and, you know, I guess today people are seeing codes over by 1,300, right? Is that, first of all, you know, we're a country where people, again, low trust environment, people love to speculate, right? So people got dollars at 990 last week and said, you know what, I can sell this thing on my app for 1,270, right? So somebody went out there, bought out all the malams of their cash, and the people obviously were flipping and made 25% within a week, right? That was one thing. The other, on the other side is, you know, which again is something to talk about, the rate at which we wanted the currency to appreciate very quickly. We forget that people actually brought in, for example, $1 million at 1,800, right? They bought securities, you know, in the market, and they'll say to themselves, you know what, the currency is now at 1,002. That means that my 1.8 billion would essentially give me 1.25 or 1.3 million dollars. So guess what? I will sell the securities, I will do a carry trade, and I'll get out of the market. So I'm just trying to break it down into ABC and, you know, for people. So right now that trade is happening. And there's obviously the third layer to that is now the investors are saying that there's obviously geopolitical tensions in the world, you know, and higher for them is, you know, the longer Fed rate. So it's unlikely that we'll see the US Fed cut interest rates again. So you know, but again, this is also happening across EM as well. So let's not say it's not exclusive to Nigeria, but that would just be my final contribution.
Yeah, thank you for that. I'll also come to that when it comes to sort of VC money and all of that. But I'm going to open it up to for questions now. I see one or two in the chat, but I'll be grateful if other people can input their questions in the chat. We can see one question from Tayo. Examples of African countries that have accessed the IMF window and are better off today would be good. Because we talk about, this IMF thing is not so bad. We're where we are. What's the big deal? So who has accessed IMF money and is better off
I
now.
think we need to start from somewhere. Which African country has been good? Right. Because I think sometimes you overthink these things, right? Because like in order for you to be able to identify the countries that have taken IMF money and are worse off, you need to be able to say these are the countries that have not taken IMF money and have done better. Right. So unfortunately, I mean, maybe someone can point me in the direction. I can tell you outside of Africa, people who have taken IMF money have done okay-ish. IMF has issues, no doubt, right? It's a Washington consensus group. Some of their prescription, especially on that structural adjustment program, were draconian, and it led to massive deindustrialization and loss of wealth. I have no question about that. I am super, super skeptical of the guys in Washington because I think they have their own agenda. And if you look at how it is, how the institutions are constituted, you know who runs the show, right? And that person doesn't think in my best interest. But at some point, right, that person's interest can collide with your interest, and then you make a decision, right? So, and IMF is not the draconian institution that it was in the 80s, right? It's trying to reform itself because we're not existing in a multipolar world. So IMF spends a lot of time. For example, in the past, IMF will tell you blackout, remove subsidy removal. IMF right now will tell you phase subsidy removal. Right. So their approach, and there's a lot of social analysis that the IMF does on the consequence of policy recommendations that it makes. So it's not perfect, right? But unfortunately, we often act like we have choices when our choices are limited. My own advocacy is that we make the right decision in the best interest of Nigeria. Sometimes that may be us, like I often say, is like going for the cleanest dirty shirt in your wardrobe when you haven't done your laundry, right? If you can give me alternative to the IMF that is better, right, that helps us solve this problem, by all means, we should take the deal. My question is, you are taking the medicine, you are taking the pill, but you're like, no, I can't take the money. When all the things that they will tell you to do, you've already done it.
Thank you for that. I was going to say Algeria hasn't borrowed. I was looking at the list. I shared the list on our WhatsApp group just now. They're doing quite well. I just learned a lot about them yesterday. I didn't realize, and we don't know that because, of course, you know what politics and mainstream media is like. But that's one country, but it's more of a welfare, military-run type thing going on there. But that's one country that hasn't taken a loan from the IMF.
See, I'd say the point I always make is I don't know much about Algeria, so I can't opine. Remember, we need to start from the perspective that before you go to IMF, you're already a basket case. You are in IMF because you've messed up, right? And so when we are doing that comparison, we kind of need to be a bit more nuanced, right? Ideally, I don't want the guys in Washington telling us what to do. Absolutely not, right? But unfortunately, give me the alternative.
Right. Makes sense.
If you give me a credible alternative, then that's fine. The alternative is you have runaway inflation, you lose, because what is happening in Nigeria, and people don't seem to understand this, is the Naira as a currency is losing credibility. The economy is getting more and more dollarized. Right? Do you really want to, if you don't want to take IMF money, you know what the alternative is? You would have to subject your entire monetary system to the whims of the United States government. That is even a worse situation than taking an IMF deal. Because you then run a dollarized economy. Zimbabwe is a classic example.
Zimbabwe, I was going to say, yeah. You literally withdraw dollars from the ATM machine. Okay, moving on quickly because of time. Anonymous question. What is the expectation for the exchange rates with what the CBN is doing? How long do we see this being sustained for? Sorry, I think maybe that was...
Sorry, say that again.
What is the expectation for the exchange rates with what the CBN is doing? How long do we see this being sustained for?
I think I always shy away from, I guess in my old life, sell side, we always would give target price. Oh, Zenith Bank is going to 100 Naira, and that's it's very different from, from FX, right? So, economists will still run, their really effective exchange rate models and tell you what number they think, right? So we've had Goldman come out with theirs, JP Morgan, etc. I think for me, what's important for me today is liquidity. Right, is that at whatever price the FX is, I can get liquidity and I can do business, right? I think our recovery is extremely fragile, right? I mean, the things that the governor has done, very excellent stuff, but our recovery is extremely fragile, right? There's still a lot of cost efficiency, right? So it's hard for me to say, oh, this is where I think the dollar, this is where I think the currency should settle. I think maybe 6 to 9 months from now, it'll be nice to see it. And I'm saying this is not me forecasting, but it'll be nice to see somewhere around 1,000.
Okay, interesting. Okay, any thoughts on the consumer credit? Okay, someone wants to say something.
So again, right, my own view, right, is you need to do whatever is necessary. And I think on the positive side, Yemi Kaduso seems to two things. He's quite committed to his parts, which is brilliant, right? And which is orthodoxy and inflation targeting. And I think if he stays true to that, he will succeed, right? But he's going to come under a lot of political pressure, especially when things don't appear to be working, right? Because remember, the people who are suffering the most from high interest rate regimes are the people in Abuja. That is the reality, and people don't know. People can't connect the dots, but they are. So if the exchange rate, if you are not gaining any success, he will come under a lot of pressure, right? So I can't. I don't know where interest. I don't know where stability is going to. When it's going to happen. My sense is that we will be in a high interest rate for longer than a lot of people think, right? That's one. So as a result, I think inflation will stay high, interest rates will stay high for longer than people think. So if you were thinking it's going to be December, it's probably going to be June, July, or December next year, right? So that's my view around that. And I think that they should stay the course. We need to slay this dragon called inflation. Because if we don't, I really, really don't think we're going to survive in a 33-40% inflation environment, because the social cost there is very high. And I think you can have a situation where civil society civil life starts to have issues. I hope that is not the case. So I am optimistic on his part, right? I think we can achieve stability if we continue down this path, but there are risks to it. I don't know if that answers the question.
So this high inflation then means things are going to continue being expensive till maybe 2 years' time, right? Samson.
I personally think inflation peaks in June, July. That's my layman view. Largely because you're coming up, because I think people often forget that inflation is a rate of change. It's not an absolute level. So the way inflation gets calculated, it gets calculated off a base. So you've had a very high base in 2023 and first half of 2022. So in order for you to have another 33% inflation the following year, you expect goods to rise 33%. When you're achieving exchange rate stability, I think you start to see inflation peaking, because a lot of the spike in inflation that happens after the devaluation was in July. So you are comparing better bases. So I think we might be in a disinflationary trend at that point in time. So I do see inflation coming down. But remember, it's a very interesting thing, right? When the currency is weakening, right, agents basically price their goods on a replacement cost basis, which is, when I sell this product, how much is it going to cost me to buy a new one, right? But when the currency is appreciating, the agents lose the cost of the price that they've paid for the inventory to determine the price. So that's what contributes to the stickiness of inflation. So there's always a lag between exchange rate stability and when inflation starts to moderate. So I think inflation moderates, right? I just don't think it moderates as fast as people think.
Okay, makes sense. Okay, 2 more questions. Any thoughts on the consumer credit scheme signed off today? Dele?
I can't comment on that. I just got off a flight, so I haven't read that piece of news.
Okay, maybe you want to expand on that, Adedokun. I don't know if Samson knows about it. I don't.
So I know the government created Credit Corp, which I think is a brilliant idea. But these are all longer term issues, right? Because you cannot be talking of credit expansion in a contractionary environment, right? I think consumer credit as a percentage of GDP is negligible, right? So there's huge opportunities there. especially on the mortgage side, auto vehicle financing, and those type of not unsecured, or on those kind of side, it requires a lot of reforms. Laws have to be changed, right, so that the foreclosure process for banks are quicker. So I am optimistic that we need to unlock consumer credit at scale, for sure. I think that is a clear need. But again, I often say credit works when income is growing. When incomes are shrinking and people are subsisting, you then layer credit on top of that. You're killing them, right?
Yeah.
So you need to achieve this growth in productivity before credit can then act as a fuel for more productivity gains. So it's something that Shiwaju has actually always spoken about, even when he was governor in Lagos State, because he's basically modeling it off his westernized experience of what credit does for a lot of people and the impact that it has on industry and productivity gains. So I support it in the long term. And it will take time for what they are doing in Credit Corp to actually start to gain a bit of momentum. It's absolutely needed. But again, a lot of things that needs to be solved, and it needs to be a back end problem. It's not an immediate priority right now.
Okay, thank you for that.
Hi,
Question.
Aramide, do you mind if I just provide a little bit more context?
Maybe put in the chat, please. I'll be grateful. So we can take one more question around
Okay,
VC, which is
actually,
critical to our audience. Sorry about that, Duku. I'm just trying to take advantage of time. Jade has said, as a founder who has secured equity funding from both international and local VCs, I'm facing a dilemma in my capital raising strategy due to the current economic climate. Given rising interest rates and increasing inflation, which prolongs loan repayments as consumer spending power diminishes, I'm uncertain about the most effective financing method. Should I opt for bank loans or continue pursuing equity funding under these economic conditions? What will be the best approach to secure capital efficiently, especially with lower valuations in this climate, which was my VC question and all that. But yeah, we'll put it all in one. Dele, let's start with you.
I think that's a tough question. And that's because, obviously, I think the first, as a VC or as a startup, I think the important thing is surviving. So you need to survive, this, because essentially whoever survives this tough period should hopefully eat the fruit of their labor, either with better valuations in the future, right? I would always say that in this period, cash in hand is better than, whatever is in the bush, right? So if you have people who are able to give you equity, whether in Naira or in FX, I would take it with all open hands, right? So a well-funded business in this environment is hard to come by. And, we obviously know that it's been so hard raising capital over the last 2 years. And I still think that drought will still be there, especially, the expectation was that US Feds will start cutting interest rates, hopefully by the second half of this year. But now that with all we've seen now with Israel and the geopolitical crisis that is brewing, is very, I would be surprised, except of course the US election will then make the US Fed cut interest rate. But, I'm beginning to lose faith in that interest rate coming down, right? So I think, again, in business, it's always nice to have a good mix. So, you can always introduce some level of debt. I think one thing that for instance, that I've told my finance teams to do is there a way where when we're taking bank loans, can we offer one thing for example, and I'll speak to what I'm thinking, is that can we use treasury bills as collateral? So essentially what I want to do is I want to buy my treasury bills today at 21% effective yield of 27, and give me a loan at whatever rate the bank is willing to give me. A lot of banks, I've spoken to a few banks about that doing such a transaction. Clearly, they're not happy about it because they're essentially what I'm trying to do, which is I'm trying to maximize my return. They would rather say, you know what, why don't you give us a fixed deposit with the bank direct, right? So they will give a fixed deposit rate, which obviously would not be as attractive as holding primary treasury bills, right? But again, you would find a way where you can, manage the margins, right? So that's something that I'm doing at this point. My business, that is the strategy that I'm thinking about, to say, is there a world where we buy treasury bills, use that as collateral for the loan, and then we'll take the loan from you. So that way I'm bringing down the cost of the funding.
Thank you. Samson, anything on the VC climate?
Yeah, I mean,
investors?
So Jadi, I don't know your business that well, so I can't really talk to specifics. But I think it's a teaching question, right? In terms of what you do in this environment. I have a portfolio of venture assets myself that I've generated over the last 5 years. And what I am doing is basically putting all options on the table. So for businesses that have strong unit economics that are growing for that are burning for growth, I've told them to slash the burn as much as they can while they try and get through this period, right? So you realize very quickly that there's a lot of fat that you can cut out of your business. And for the ones that are lucky enough to be able to get to break-even territory, I tell them to do it. It comes at the expense of growth, but this is not a growth environment; it's a survival environment. So that's one. The second thing I am exploring, right, is basically strategic transactions. So I have a portfolio company that it still has a burn enough cash or enough runway in the bank. I have another company with a good product that is running out of cash. Can I get them to marry each other? Come up with a conversation that allows both of them to survive, and then they create a bigger company and improve the probability of survival. We have to be very, very creative. I am of the opinion that 2020, 2021 were aberrations. I don't think that the funding environment for the foreseeable future is going to get anywhere close to the euphoria of that period. And frankly, I am also of the opinion that a lot of businesses got funded that should never have received capital. So there will be a lot of debts, right? But if you have a business that is sound, has a positive unit economics, you should try and cut burn as quickly as you can, explore strategic options. Debt is super expensive at this point because you are giving equity-like return to the banks. Like interbank borrowing, the banking system is short liquidity. So for them to be able to even lend to you, they need to go and borrow from another bank. And if they go and their bank borrowing rates are 30% plus, they need to put a margin on that, right? Yeah. Frankly, when you are borrowing at 40% plus, right, you need to be making 120, 130% margin on what you are financing for it to even make sense. And I find that very, very difficult to achieve. So it's not what I would recommend, but unless I know your business, if you have such a fantastic business where the margins are that high, by all means, you can afford to adjust. But if you have a business where you have uncertainty around your margin, right, because it's not very stable and it's volatile, to go and take a fixed charge of 40% against that is a very, very risky strategy, in my opinion.
Really great insights. Thank you so much. We have run out of time. I have to apologize for those who would have liked to ask more questions and all that, but we're just trying to manage time as well. I want to say big thank you to our panelists and ask them for a leaving sort of like, and I know you said, it depends, context is key, communication, be creative about your fundraising as a business owner, but anything that will be useful for a business owner or professional as they think about their investing or fundraising journey. Any parting words? What would that be? Dele and then Samson, please.
I think I did investment banking for 15 years, and now I'm doing startup, and I'm just wondering, how exactly did I find myself in this conundrum? But it's been very interesting. It's been a great learning curve. I think the important thing here is obviously is unit economics. So, the whole thing about growth without profitability, that's out of the window. So you need to be laser focused on how can we get the company profitable, which obviously goes to, what's your burn rate? I think for the best part of it, people have, what you're solving for. There's always a great mission you're solving for, but it's also ensuring that, you're solving for that great mission is that you're able to sustain yourself, right? So staying alive and just staying afloat is probably the most important message I can tell anybody in the VC space, and is given my own situation. The truth is, and the honest truth is, you're going to have great business models. We're going to have companies that would fail, and that comes with it comes with the turf, right? It would happen. You can have a great company solving a great problem, but the cash just runs out. And it's also a great time to have very supportive and understanding shareholders. You'll be amazed at what that can do for you, especially in this tough period. But I think it's just, just stay strong, stay steadfast, keep doing what you're doing, and you know what, you win or you lose, but keep your head up even if it went the other way.
Thank you. And Samson?
Well, I would say that the finest diamonds are made under the harshest conditions, right? So I am optimistic. I know I don't sound like I am, but I am optimistic that actually we are now dealing with people that we can actually engage, right? You're now in the realm of rational conversations. In the last 8 years, like the people who were in the political and economic, I don't know the right word for it, but the people who made the decisions were completely out of tune. You couldn't talk to them, you couldn't engage them. I've seen situations where like, Cardoso has backpedaled. Like, for example, when he widened the asymmetric corridor on the SDF, he got feedback. The next meeting, he narrowed it, right? These people are accessible, right? You might not be able to access them directly, but you can access them. And I think there's a baseline level of rationality that allow you to think about their decision function and how they intend to operate. And I think that's a massive departure for what we've had in the last 8 years. So we are going through this adjustment process. It's extremely painful for everyone, right, including us, right? But I see light at the end of the tunnel. I think this environment looks a lot to me like 1999 after the debauchery of the military era, right? And we are now kind of going through that adjustment of the first 2-3 years of that period. We have to remember that when Obasanjo came, 2021, 2020, 2001, 2002 were horrible periods, right? We only started to get the benefit of the reform from 2004 onwards, right? That's where we are, right? And for me, across the asset class that I invest, I see a once in a generation opportunity to make excess return, right?
Sure.
So I am positive from that perspective, right? It's just a very difficult time in identifying the people who are going to win in this environment and trying to avoid people who have defective business models or people who are running out of cash or et cetera, et cetera. So if I think about investing in Nigeria, right, I am probably the most optimistic that I have been, right, since I started to look at Nigeria as an asset class in 2008. I'll put it there.
Amazing. I've never joined a sort of finance webinar or event that was so interesting and engaging. I want to say a big thank you to both of you. Thanks for the time, the knowledge shared, and thanks to everyone who's joined today. Please endeavor to find out more about our network through our website. I think it was presented earlier, and we'll be sharing more details around future events that you can participate in. Thank you, everyone. Until next time, have a good week, month, year, quarter, whatever it is. Thanks, guys. Thanks, everyone. Thanks, Samson, Dele. Bye.